Welcome back from the break, everybody. Did we have a good break? Well, I suppose everybody just kept on going to work like you would normally do. Obviously, everybody, if you're following me on Facebook, you know where I went over the break. We had a great 2 weeks away. Since we've been on a bit of a break for a little while, do we want a little refresher of where we should be at? Yeah. Yes? All right. So let's just change to that one. Okay. So let's start with where we are in terms of everything. And this is the same, you know, I always start with this sort of stuff. We have our audit report. We know that for our audit report we have to generate audit evidence. So this is all stuff we've looked at a few times before. With that evidence we're looking for misstatements. And we're not looking for all of them, we're looking for the material ones. So we have to consider materiality as an issue. Our evidence is generated from our audit programs. All right, now audit programs are like our recipe of what we're going to do. And as part of our audit programs, we can do either substantive testing or we could do controls testing. And the decision on what sort of testing we're going to be doing is driven by the audit risk model. All right. So the audit risk model helps determine our detection risk, and we gather information from the audit risk model from our inherent risk and our control risk. I won't write the full names there. Okay, so let's draw some arrows so far on where we are. Okay, audit report is the output. We have audit evidence. I might make that arrow a bit smaller. Okay. Our evidence, we're looking for misstatements, but we're only looking for the material ones. The evidence comes from our audit program, and our programs could be testing controls or substantive testing. That's driven by our audit risk model, which uses inherent risk and control risk. And we know that control risk is based on our understanding of the internal control framework, and our inherent risk is based on having our understanding of the client, which comes out of ASA 315. Let's make that there. Okay. When I'm considering my audit evidence, I know that I also need to think about sampling because I'm not gathering evidence on everything because that would be just too hard. I need to think about sampling. My sampling will be affected by my materiality and the stuff that I find out about that feeds into the audit risk model. Now, what we've been spending a lot of time on is the stuff around testing. All right, and what we've done really when we've looked at testing substantively and internal controls is really the design part. All right, so we've looked at designing procedures, and designing procedures we need to follow our 4 rules. All right. And so rule 1 was about using audit terminology. Rule 2 was about using client terminology. Rule 3 was about specificity, being nice and detailed. And then number 4 was about matching the procedure to your objective. So, if you're testing accuracy, you want to do some form of recalculation. So our methods for collecting evidence, I suppose, come from, oops, that's a bit of a big arrow, those 4 rules. Okay, and we know that we have a mix and match of procedures, our vouching, tracing, analytical procedures, inspecting documents, inspecting physical assets, recalculating, reperformance, observation, inquiry, and confirmation. Okay, so that's where we've spent a huge bulk of our time in learning how to do the design aspect of this to be able to generate audit evidence. And this will be our last week of learning about that. And then we're going to focus on what happens to get to this audit report. And there are a few little steps in between generating our evidence and coming to the audit report that we're going to spend 2 more lectures on. So that's sort of we're coming to a close over the process of the audit. But this is really the key of where the video interview stuff is about. And this is the hard part for accounting students because we're not really taught to be creative. Creative and accounting usually are 2 words that we don't encourage students to put together unless you're really stuck on your journal entries. But here we're going to be creative in terms of the requirements for design. So that's where we are, and we're going to focus on our last bit of substantive testing today. We looked at transactions 3 weeks ago, and today we're going to look at balances. So really, what we see here is nothing new. What we're going to do is we're going to look at substantive procedures for cash, receivables, inventory, PP&E, and payables. And then not more importantly, but just as important, we're looking at assessing the results of our substantive testing. All right. So if I was sort of to break these into some groups, this part here is all the stuff relating to design and creativity. What do we do? How do we do it? And then the assessment of the results is all about evaluation skills. All right. What do I do with the evidence that I collect? What's my next step? So you'll notice that the lecture is actually going to be sort of a repeat of the same sorts of things for each of these areas. What are the assertions at risk? What are our audit objectives? And then how do we collect that evidence? All right, so the first one is we know that the auditing standards have some specific requirements. So ASA 500 says that I must collect sufficient and appropriate evidence to be able to generate my audit opinion. And that I need to consider the nature, timing, and extent of the audit procedures I'm going to use to gather that evidence. So nature is which procedures, timing, when do I collect them, and then extent, which is how much. All right. So since we're talking about extent, this must mean that we're also talking about sampling. All right. How much evidence to collect? Which, and I'm a little bit rusty because I've been on holidays for a few weeks, I'm pretty sure is ASA 530. Yep. So how much evidence to collect is affected by how much risk? More risk, more evidence. Sometimes for small accounts, for a $500 account at News Corp, we might either not test it at all or just do some basic analytic tests. But we use the audit risk model on significant accounts. So while we've looked at the audit risk model on the whole company level, we'll also use the audit risk model on key accounts for sales, for accounts receivable, inventory, because the level of inherent risk and the level of controls could be different for different parts of the firm. Lots of companies generally have really tight controls over paying out cash because of accounts payable, but they might have less controls over receiving money from accounts receivable or from sales. So therefore, we want to take different approaches there. So we use the audit risk model where there's high control and inherent risk. And of course, we know that when control risk and inherent risk are high, our detection risk is what? Low. Excellent. That we're not going to test internal controls, and we're going to do mostly that substantive testing. When there's low inherent risk and control risk, and detection risk is obviously the opposite, which is high, I'm going to focus on testing controls and only doing a small amount of substantive testing, testing 25 or 15 transactions. So in terms of nature, timing, and extent, now we're on to the idea of timing. When? Now remember here we are looking at the balance sheet. Okay. So balance sheet items are made up of lots of small transactions through the year to come to the value at the end of the financial period. So as a result, because of the way the balance is constructed, I can't really test a balance at the interim point, at 3/4 of the way through the year, like I can with sales. So with sales, I can really test the first 3/4 of the year before the end of the financial period, and then at the end after the end of the financial year, test the last little bit. But that doesn't really work for balances, right? I can't come in March and test the balance of inventory, or what we're looking to be the balance in June. So that doesn't quite work. That means in terms of timing, we tend to look at the end of financial year for a lot of the work relating to balances. Year end there. So we often look for major events like buying stuff. Sometimes we might do some interim work, but it generally makes sense to focus on the end of the financial year. This diagram is nothing new. We've looked at this sort of thing a lot in the past, where we have so this section here, let me just annotate on this, a different colour. So this section here is low control risk. All right, this section up here is high control risk. All right, an inherent risk where risk is low, we're going to rely on tests of internal controls, whereas when there's high risk, we're going to do lots of substantive testing at the end of the year. So that's nothing new, it's just a diagram we've seen before. So what other things do we need to consider? Specificity of the client. All right, so different clients may have the same overall level of risk, but risk could be caused by different factors. All right, so you might have two pharmaceutical companies, both might be medium or high inherent risk, but that could be for different reasons. One could be because of compensation structures. The other could be because of company organizational structure or the number of joint ventures that they have. So that is where making sure that we understand the client under ASA 315 really comes into play, by making sure that we can identify what specific risks we need to worry about at that particular organisation. So if a company perhaps is in pharmaceuticals, they've got a warehouse, one company might outsource their security to a company that has recently been in the news for having security guards involved in a lot of theft, then you might say, oh, look, that's quite high risk. Similar sort of company with a different setup on security. They've got their own security guards, regular training, everybody has to be qualified. Then if that's low risk, you can have a different approach to auditing inventory at both of those places. So it's just about being flexible and adaptable. So that we can be efficient. All right. Take credit for work that's already done. So that might mean also looking at the work of internal auditors, if they've done any, which I think, it's either going to be ASA 610 or 620. And then also considering how much evidence we need to get from our testing. So let's look at the first one. And I'm going to start with cash. And the reason why cash is number one is because cash is the oil, or really, I suppose it's the petrol or fuel that keeps an organization going. All right? Without cash flow running throughout the financial period, company's not going to be able to buy the inventory it needs to be able to sell to customers to make money. So cash is key. This is why when you're doing analysis of organizations, you not only look at profit from the accrual basis, but you also look at cash flow in the organization. What is operating cash flow as well as overall cash flow to make sure you get a good picture of the firm. So 3 important things. Number 1, is the money really there? Or are they just making it up? Number 2, has all the money been collected? And then number 3, has it been classified correctly? Now, from my perspective and my practical experience, these 2 are the killer ones. All right, the ones that are really, really important. First one, does it exist? And you'll see here that we test that using something called a bank confirmation. Remember, we've got our list of procedures there. The auditor will write directly to the bank. And in the old days, we used to fill out a form and attach a check and give it to the bank. They would fill out the confirmation and send it back to us. Now confirmations for a lot of companies are done online. So you can actually go to the website, put in the company's details, you pick the list from a list of publicly listed companies, pay your fee online, and then they send it to you electronically. But that's an official letter that says, this is the money associated with this particular company, and often you'll have to get confirmations for every single account, or they can give you all of them together. So the confirmation proves the money is really there. The second, now of course, this does rely on a good banking system. So a bank confirmation in Australia is really reliable evidence. A bank confirmation from a bank in Zimbabwe or something from a country that's experiencing a lot of civil strife. So if we wanted to get bank confirmation from Syria or from the Sudan or somewhere else that's a little bit tricky, I might not rely on that evidence so much, especially in Zimbabwe because, Robert just prints his extra money. Oh, we're running out of money. Let's print some more. So we don't know how great the banking system is there. So, of course, that we assume that banks are trustworthy. The second one is completeness, and the procedure there is to do the bank reconciliation again. So almost everybody here is working in some way, shape or form. But for all those people who might be listening to the video and wondering, why is the bank reconciliation important? Former students who are out there in the audit world say that the first thing that you need to be able to do on an audit is the bank reconciliation. All right, even if you go for a general accounting job. So if you can't do one, learn how to, because we need to make sure that the bank rec has been done correctly, and if it hasn't, what the issue might be. And I've certainly come across bank reconciliations where even the accountants didn't know what they were doing at the client. And we once saw a little line that said, balancing item in brackets, check this before the auditor comes. So they'd obviously forgotten that that was still in there. That also happened in New Zealand in a published set of financial statements. And I think it was Parmalat, which is a big dairy organisation in New Zealand. If you have a Google, you should be able to find it, where they'd left in a line that said, balancing figure. Like something that they were trying to fudge because they couldn't get it to balance, the balance sheet to balance, so they'd put this extra line in. And somehow it got published in the actual annual report. I'll see if I can find the image for that and send it out to you guys. But the bank reconciliation is really important. You'll use the bank statement that you'll often get from the bank confirm. So it's really important that you know how to do the bank reconciliation. Other things that are important, rights and obligations. Do we own the cash? Having a right to the cash, you'll find out that from the bank confirm. So the confirmation will give you a lot of information there. And then the valuation and allocation. Now, the valuation sort of flows on a bit from the bank confirmation. The bank reconciliation. If your reconciliation's not right, your valuation won't be right. And you can have issues if you've got foreign currency accounts. especially if you've got lots of foreign currencies and they're not protected in any way by any financial derivative. Sort of like when I was on holidays and I'm in the US, and after the first few days, I just stopped looking at how bad the US Australian dollar exchange rate was. I just accepted that everything was going to cost more, and I just pulled out my credit card. I will worry about the bill later. So, I came back from my holiday, had a fantastic time. I am now not very broke, reasonably broke. But, that's what I have a paying job for. And I'm an accountant. I'm not going to be broke. But, I'll be at my safety net of funds. Doesn't everybody have a rainy day fund? No? Most companies should, right? Yeah, they should have a minimum level of cash flow. So, I'm getting close to my minimum level of cash flow. Now, these objectives are really nothing new. The objectives are simply our assertions written into sentences. So I'm not going to go through these because you guys can read. Everybody proved that from the midterm. They did really well in the midterm exam. So this is really just taking our assertions, put them into sentences. What I really want to talk about after this is actually the procedures. Now, in terms of the processes impacting on cash, cash comes up everywhere. All right. When I make a sale, I go debit cash or accounts receivable, credit revenue. All right. When I buy something, I go debit expense or inventory, depending on what I'm looking at, credit cash. I make a payment on my loan. I go debit liability, credit cash. So cash is in lots of different transactions. That means that when I'm testing sales or I'm testing purchases, I'm also partly testing cash. So that gives me some efficiency. All right, so here are all just samples of the processes, but what I want to get to is hopefully the next one. Substantive testing on cash. All right. You would always do a significant amount of substantive testing on cash because it's easily stolen and it's really important to the business. All right. So cash is always going to be one of those high-risk accounts. And so we've talked about doing the bank confirmation, the bank reconciliation. You could even do some analytical procedures. You could look at the number of sales made less the number of purchases and see if that roughly approximates what you have in cash. All right, so what sort of tests do we always perform? So there's a couple of different things here. And sometimes I will agree with these and sometimes not. The confirmation, always do. Right? It's the first thing that you will start with. Then looking at the client's bank reconciliation, sometimes we might need to re-perform it. And this cutoff test actually normally happens as part of the bank rec, so that's not a separate thing. Look at any unexpected changes in balances. This week, Cloud9 said recreate the financial statements for the firm. I didn't get you to do that. Instead, what I've actually done is I've just given you the recreated financial statements, but you'll notice that they had $1.7 million of cash last year and now only $600,000 or something, and you're like, where the hell did all that money go? So we're looking for unexpected changes. We might look at interest and see whether that matches up with loans. Looking for unusual items, big deposits or big withdrawals. Minutes of meetings to determine whether we might be expecting more money or less money being paid out for certain items. So these cash testing is pretty standard across lots of different firms because almost everybody handles cash the same way. We're always going to do a significant amount of substantive testing. And when you start on an audit, in any audit job, your first audit experience will be in either cash, sales, or accounts receivable. All right, which is why I'm going to focus on those three areas as part of today. All right, let's look at the second one, receivables. So trade or accounts receivables. And here I'm going to talk about something that, it's a little bit weird. The first issue is the debt real? And that's because fake customers is a great way to hide fraudulent sales. create a fake customer and you can go debit accounts receivable, credit sale. And then if you know somebody in accounting, you could collude with them to write off the bad debts of those customers because they're never going to pay. So knowing that they're real is really important. You can do that via the debtor's confirmation. So that's the letter that you send to them that says, please reply and tell me whether this is the amount you owe our client. Here's the issue with debtor's confirmations. The issue with debtor's confirmations is hardly anybody ever replies. Less than 10% of people reply. So it's a very inefficient and ineffective audit procedure. There's a YouTube video I talk about debtor's confirmations and I go on a bit of a rant, really, about why firms still do them. When I asked an audit partner maybe 15 years ago, he said, because we've always done them. They're tradition. It's a traditional thing that we always do, but it's really not efficient. We also need to test the valuation and allocation. So is it real? Is the dollar amount correct? Now, allocation is normally current or non-current. You don't normally have any non-current receivables. Now, let me just check something here. All right, so in terms of other assertions that are going to be important, classification a little bit, only because of related parties. Do I have a right to recognise that asset, which means, did we actually transfer the good to them? And then completeness, which is understatement. Could we be missing any accounts receivable? This one is unlikely for most companies because companies are more likely to overstate assets, understate liabilities. So actually I might put the debtor's you can watch the video on YouTube about debtor's confirmations where I talk about pros and cons of confirmations and why the confirmation isn't a great tool. In 2 slides, I'll create a new slide that talks about something that's better than the confirmation. All right, so here again are my basic assertions, all right, my explanations of my assertions, so that's nothing tricky. What transactions are important? Sales, of course, because we go debit accounts receivable, credit sales. Cash receipts, because we go debit cash, credit accounts receivable. All right, so that just proves that we've got some related accounts that could be important. So we've got some samples of samples of some substantive tests here. You can read through those. But what I'm going to do, I think on the next one. Here we go. Okay. After this one, I'll add an extra slide. All right. Now, it says tests always performed, and it says confirm accounts receivable. That is now no longer the case. So maybe about 5 years ago, audit firms started allowing audit teams to opt out of doing the confirmation and instead opt in to something called a subsequent cash receipts test. I'm going to just type that in there. All right, so the subsequent cash receipts test is the alternative test, and I'm going to describe what that's about. We might look at all the supporting documentation. The allowance for doubtful debts is a really critical one here. And you do that by probably aging your accounts receivable, which I think is down here. So aging your accounts receivable is simply stratifying accounts receivable into different groups. And those different groups are usually less than 30 days overdue, 31 to 60 days, and then 60 plus days. Now, at which point out of these 3 are you expecting there to be bad debts? Number 1, number 2, or number 3? Number 3 is where you expect the bad debts. So by looking at these ones, that'll help tell you which ones might need to be written off or go into the allowance for doubtful debts. So this is something here that is always done. I've never seen an audit where we've not aged accounts receivable, unless there are no accounts receivable. You might also do some analytics in terms of here, doing comparisons of percentage of amount as doubtful debts and write-offs from last year. So if 7% of accounts receivable was written off last year as a bad debt expense, then your provision this year should be roughly 7% of this year's accounts receivable. And then you can evaluate that. You'd actually do all of this work under the rules in ASA 540, which is the accounting standard for auditing accounting estimates. We'd also do a few other small things like creditworthiness of new accounts. We gave people credit. Did they pass credit checks? And then this last one down here is really some mathematical checks on the accounting system itself. So making sure that subledgers add up to the total amounts in general ledgers. If you're using any form of modern accounting software, errors here are really difficult to generate because most stuff is automated. So I'm going to add an extra slide now on something that is really important that is called the subsequent cash receipt test. Oh, why has that come up grey? Let me change the colour. There we go. All right. So the subsequent cash receipt test works like this. Here is the end of the financial year. Okay? And what I have at the end of the financial year is I have debtors. Let's say debtor A, debtor B, and debtor C. And I need to figure out how much they owe. I send them a confirmation letter, all right, and they don't reply. So, you know, the process of a confirmation is normally that at this point we send them a little letter and say, please reply. Typically they don't. So another few weeks later we send them another letter and say, can you please check the confirmation? Still no reply. And then at this point over here, which is usually 6 to 8 weeks after the end of the financial year, which is quite close to the deadline for audit reporting, I need to figure out some other way besides the confirmation to gather evidence on how much these people owe. So what I do, and what is now becoming a more popular approach, is the subsequent cash receipt test. And so what I do there is I know that if a client owes me money here at this point, sometime between now and, let's say, 4 to 6 weeks post-financial year, those people will have to pay their accounts receivable. All right? So what I'm going to do is I'm going to look for cash coming in, cash receipts. I might find $15,000 here, and I find $20,000 here, and I find $25,000 deposit here. Okay? So what I do is I look and I see if I can match these back to a customer for their accounts receivable. All right, so I find this one belongs to customer A. So I can confirm that customer A is real and owed $15,000 at the end of the financial year. All right. I might discover that the $25,000 belongs to customer B over there, and the $20,000 belongs to customer C. All right. Now, this is better than doing this option because I haven't wasted money on letters and stamps to people. Yes, I have to wait until a little bit after the end of the financial year, but I've already got a bank statement with lots of transactions on it. Don't need to go and write to anybody. I can simply look at these figures and do a quick check back to make sure that that's a real customer. All right, so the payment means that that's a real person. If it was a fraudulent accounts receivable, we'd have no money over here. or it would tell me that needs to be written off or gone into the provision for doubtful debts. So does that process for the subsequent cash receipts test make sense for everybody? Yep. Okay, awesome. Moving on. So now let's look at another important one, inventory. Inventory is important to the majority of firms because if you don't have inventory, you can't sell anything. If you can't sell anything, you can't generate cash. If you can't generate cash, you can't pay your loans, your overheads, your wages. And then your company's dead in the water. So what's really important? Is it real? Right? Is it really there? Or is this like, does anyone ever remember from a few years ago, a company called Firestone? All right. So Firestone, they were sponsors of the Sydney West Tigers. What's the Perth rugby team? I don't know, I'm not a rugby person. Western Force, I think it was. And they'd convinced a whole lot of people to invest and that they were selling this pill that you put into the petrol tank and it made the car super, super, super efficient. All right. Lots of big name investors put money in, and in the end they discovered that all the sales that they'd been making and the product that they were manufacturing was all a lie. So we need to make sure, is what the company's selling really real? I got another example of, we all know USB drives right now, but back in and I'm trying to remember what year it was, when USB sticks were first new, a company that manufactured them created a whole lot of empty boxes and put them on the shelves and told the auditor that was inventory. So they opened up a few and found USB sticks in them, fine, but then there were whole lots of other boxes on the shelves that were just empty boxes that the auditor counted as actual items. So we want to make sure it's really there. And you'll notice that ASA 501 is mentioned here. Auditing inventory is so important, it has its own standard. All right, it says existence is real. So we must check that inventory is really there. I must look at it. All right, so physically put my eyes on it, hands feel that it's a real item. Where there's low risk, stock takes annually, but a stock take is generally only once a year, where I need to verify that actual inventory. The other thing that's a big one is valuation. All right. Now, what did we learn in cost management systems with David Bedford? Product cost is yeah, so there's the sort of break-even type thing, but the product cost is the direct materials plus DL plus OH. All right. Now, the direct materials and the direct labour part, that's reasonable to calculate. But the part that becomes more tricky is this bit here in terms of overhead. Who remembers the different sorts of methods for calculating or allocating overhead? Well, there's a few different options. We've got our plant-wide, all right, department, and ABC, all right. Now, companies choose one of these to use, and then we make lots of assumptions and decisions on cost pools and cost drivers to come up with this item here. So that's why valuation can be really tricky, because we've got to make sure that the company is doing this correctly. So the auditor needs to know not only about financial accounting, about auditing, but also about management accounting when it comes to doing inventory. Now, we know that there's certainly some basic rules in regards to valuation of inventory, lower of cost or net realizable value. So you need to do some research on net realizable value. We might need to look for stuff that might need to be written down in value because it's old, damaged, obsolete, impaired. So we might do some vouching, do some recalculations. There's certainly going to be lots of recalculations involved here for inventory and analytical procedures. Right? If I'm trying to find slow-moving stock, I'm going to start by doing an analytical procedure calculating inventory turnover for each product and then sorting them slowest to fastest moving. So we've got our valuation. Now, allocation typically implies whether we are thinking current or non-current. So what sort of industry might I be in to have non-current inventory? Wineries, yep. So wineries and distilleries for spirits are the things where you're most likely to have non-current assets, non-current inventory especially. Valuation of non-current inventory, you use the lower of cost or net realizable value. But then you also need to talk to the client about, how do you know which wine you're going to stop aging and then put in the bottle? Because it's not an exact science if you put it in for 5 years or 4 years. There's lots of complexity in that to determine which wine will turn into current inventory and which wine will stay as non-current inventory. It can get a little tricky. We've also got to worry about completeness. Are we missing any inventory? Do we actually own the inventory under rights? And classification is not usually a big issue there. So again, here are our assertions relating to inventory. That's pretty easy. You guys can read those. Of course, we have some journal entries that come into play because when I buy inventory, I go debit inventory, credit cash, or accounts payable. All right. When I buy or when I pay for my inventory, obviously I go debit accounts payable, credit cash. And then if I'm buying raw materials and making that inventory, I know I need to do things like debit work in process, credit raw materials. I'll also do things like debit finished goods inventory, credit at a work in process. All right. So there's lots of sort of transactions that are going on in there. So how do I test inventory? And again, I mentioned before that it's so important we have our own auditing standard specifically for inventory. So I have to be there at the physical counting, unless it's impractical. So the auditor of Woolworths cannot send an auditor to every single Woolworths on the 1st of July to observe stock takes, or that's not their end of their financial year, but they're at their end of their financial year. But I do things like, how are management instructing people to do the stock take? Do their procedures look good? Could there be any extra controls implemented? I'll observe people counting. I'll walk around sort of like exam supervisors watch you guys in the exam room. The auditor will observe the client counting with the hope that with the auditor watching, the client staff will do their counting correctly. We'll look at inventory for anything that could be old, obsolete, damaged, and then we'll do test counts. So after the staff have done their counting, I will go and I will select some and I will reperform what they've done. All right, to make sure that it has been done, reperform. To make sure it's been done correctly. Now, this is what we'll do in a situation that is low risk. All right. In a situation instead that is high risk, then the auditor will do the actual counting. All right. So that could be if you're auditing perhaps a jewels company, or that process diamonds. If you're auditing Bentley or Rolls-Royce or Ferrari, you would probably do the stock take yourself. Of course, it'd be impossible to get enough auditors to do the stock takes at Woolworths, but for high-end, high-risk items, we will often do the counting. Sometimes that's less than glamorous, especially when it's dirty. I will also usually do some analytics, all right? And the analytics are nothing that we haven't already talked about, right? Opening inventory plus whatever we produce, less whatever we can sell should equal what we have as closing. All right. I could even do the analytic of, remember doing variance analysis? Yep. I could take standard material usage, and if it was supposed to be, 1,000 kilos made 1,000 units, then I would look at actual units produced. Oh, we only made 500 units. What happened to those others? Was there wastage? Was there theft? Has something gone on? So we can do lots of analytics to help us identify something if there's something unusual. Those analytics can often be linked to valuation. We can look at how do they evaluate items for damage, costing methods by doing recalculations. And obviously you guys will use Excel to do a lot of this stuff. In the old days we used calculators. And then what are we going to do about remote locations? Sometimes you might be able to send someone to observe, or otherwise you might just have to take the auditor's word, that the client's word that they're doing it correctly. All right, property, plant, and equipment. Okay, so this is, the buildings that the organization has. It's the machines, it's the computers, it's the furniture. So we call them generally fixed assets, and they're all recorded on a fixed asset register. So it's like a big document. This is often some sort of Excel spreadsheet. Even in very sophisticated companies, I went to some pretty big multinational companies that would still keep their fixed assets on this big Excel spreadsheet. A lot of companies now have got software for it, but it's supposed to capture items that we buy, items that we sell, depreciation, and how the depreciation is calculated to come up with the written down value that is supposed to be reported for property, plant, and equipment, right? Because it's original cost less accumulated depreciation, and you get the net value recorded on your balance sheet. And this is where it gets really tricky, because companies have lots of stuff, all depreciating at different rates. And in big companies, they might not be capturing all of the additions and disposals. So biggest things, are they real? Because, who hasn't taken home a pen or a piece of paper from work? So we want to make sure that everything is real. And for us, especially, the tricky part is the valuation, all right? Because lots goes into, for example, the initial cost of property, plant, and equipment. It's not just the cost of a new machine, it's installation costs, it's setup costs, it's testing costs. And then you have to figure out useful life, salvage value, right? And the difficulty here is because all of this sort of stuff is estimation. All right, and we use ASA 540, which is the ASA on accounting estimates. All right, the computer does not go, "Hi Amanda, I was $378 worth of depreciation this year, and my useful life is 2.75 years. Okay, we make our best guess, professional judgment guess, on what the value of the item will be over what period of time. All right, because a computer that we think, right now it's top of the line, so when I salvage it, I think I should be able to get $500. Something brand new and fancy gets developed, and suddenly it's worth $100, and we need to adjust. So there's a lot of estimation. Management make their judgments on useful life and salvage value and what goes into the original cost, and we need to evaluate whether their judgment is appropriate. All right. So ASA 540 says that when we're testing estimates, we need to test in two different ways. The first way is a mathematical check. All right. Is the mathematics and the mechanics of it sound? The second thing that we need to consider is, have they used the right assumptions and developed the right sort of model? All right. I've come across clients that said, this machine should last us 20 years. I'm going to depreciate over 20 years. And then you look at the manufacturer's documentation and they say, the expected life of all of these parts is 10 years. And you go, hang on a second, you guys have used the wrong assumption. They might try and overinflate the salvage value or not include the appropriate costs. So when we're looking at anything that's an estimate, I have to audit the mathematics and whether they've used the correct model. And this is all to do with the valuation component of it. We need to make sure that when they sell stuff, we've taken that and done that correctly, and then made sure the depreciation is appropriate. So if you know a company bought a whole lot of new assets in the year, but depreciation expense is still the same as last year, they haven't done the depreciation there. Completeness, not usually an issue because companies don't tend to understate. If we're looking at rights, we want to make sure we own things. That's usually the big key ones there. Our objectives are our assertions. All right. So we know that we have to buy, we can sell PP&E to get cash. We can buy PP&E, that means cash goes out. And then there are also issues around finance v. operating leases. Because when you have leased items, obviously your finance lease items still need to go on the balance sheet, still need to be depreciated, so that's a bit of an issue as well. All right, now we're going to move on to payables. So this is the outflow of cash. All right, paying for our stuff. And here, the most important assertion is understatement. Right? People never want to show too many liabilities. And here you'll see something called the subsequent payment test. It's the exact opposite of the subsequent cash receipts. All right? So a company can choose not to record the journal entry for an accounts payable. We bought something, but I'm not going to record it because I don't want it to show up. I want my payables to be lower. Okay? Even if you don't record the journal entry, do you still owe a supplier some money? Yes. Is the supplier still expecting you to pay? Yes. And if you don't pay, what happens? You get in trouble. They send you a debt collection notice, or if you've bought from someone shady, they send a big muscly guy with a baseball bat around to, do your kneecaps in. So what I do is I do the exact opposite of the subsequent cash receipts test. I look for money that's going out of the firm that cannot be matched back to a valid accounts payable or other sort of loan. And that could be evidence of an unrecorded liability. Money that we owe someone that we're pretending not to record, we're not recording to hide it. We might be close to breaching a ratio, for example. So the completeness assertion for accounts payable or for any liability is the most difficult assertion on any account. So of all the things to audit, the most difficult thing to audit is completeness of liabilities. All right? Because you don't know if the client is trying to hide something or whether they have recorded anything. So you're potentially trying to find something that might not be there. It's sort of like saying somewhere in this room I may or may not have hidden an invisible block of chocolate. All right? How do I find something that could be there or might not be there at all? So it is the most difficult assertion to gather evidence on, but the subsequent payment test is probably the best way about going forward on it. Existence and rights and obligations are not usually a huge issue. You might need to make sure you understand the related party transactions, but the big thing is completeness and valuation. Have we recorded enough? So sometimes you might include it, but you might exclude some purchases and undervalue your accounts payable. So there's some your assertions there. Obviously, we have our cash payments because when I buy things and then when I go to make the payment, I go debit accounts payable, credit cash. All right. And when I buy things, I go debit expense of some sort or maybe inventory, credit accounts payable. Okay. Now, this is a really high-risk area of cash outflow, so you're probably going to do a lot of substantive testing. We don't have a diagram in here that shows the test that we would always do or sometimes do, or analytics, but it's reasonably simple. You know, I've talked about the cash payment test. That's probably the most common thing that we'll look at. And then you've got these other accounts. Now, these other accounts, you can have a read of, but it's not that they're difficult to audit, but the most common ones, cash, accounts receivable, inventory, PP&E, and payables, are the ones that you will focus on auditing in your junior career. All right, in your career as a junior auditor. These sorts of things you'll do as you get a little bit further along. Obviously, ASA, the provisions, is lots of professional judgment, which is why it tends to be done by senior staff. Taxation has a whole range of other issues. Leases and equity. The leases, we've looked at the financing versus operating issue, which means you need to know how to read the legal contracts and the accounting standards as well. All right. Now, my job is to look for and come up with dollar values of errors, determine whether there is any sort of material misstatement, and present that to management. All right, but there's a few things you need to do first, and I've said a few of these are really important in the past. The first one is, why did the error occur? Is it a control risk issue, which means that I could have the same small error replicating itself over and over and over again, creating a big problem? Or did somebody accidentally chop off half their finger doing home repairs on the weekend, and they've now got a big bandage on their keyboard finger, and they've accidentally typed 5,000 instead of 500 because of the fat finger issue? So knowing why the error occurred will help decide whether you need to do extra testing. If it's a one-off, probably not. If it's recurring or a control-related issue, then yes. Make your estimate of your misstatement, and remember, we already talked about that estimate comes from the work that we did before on projections. Think about whether we have materiality issues, and recommend an adjustment. I'm going to talk about adjustments a lot more in the future, but those are the basic steps. So let's work through, how are we doing on time? Oh, we've got a few minutes. All right. So let's work through an example. Anyone here work at a company that makes stuff? No? All right. Anybody work at a company that sells stuff? Yes. Used to. Yeah, okay. All right. So maybe I'll pick something out of thin air then. Hang on a second. All right. So I'm going to pick a company. Let's look at Apple. I was looking at the new iPhone just the other day. Bloody hell, it's expensive. I don't know if I can justify the expense at this point. All right. So let's look at Apple, and let's think about they did inventory this morning. We did Volkswagen this afternoon. We did Volkswagen. And we did inventory. So let's look at something else. Are they going to have much in the way of accounts receivables? Probably not. Let's look at accounts payable instead, because that's going to be a little bit more tricky. I may be biting off more than I can chew, but we'll figure it out. Okay, so we're going to do Apple and accounts payable. So I need to prove for the first one that my accounts payable really does exist, so that I really do owe suppliers money. All right, so there's a couple of different options. I could send a confirmation request to a supplier. They're never going to reply. All right, I've given myself a hard task here. Let's do that by vouching a sample of accounts payable suppliers. 2, proof of goods received at warehouse. All right. So if, we owe, for example, Samsung or some other company some money for making a component, I'd want to see that we've got proof that we actually received that component, goods received at warehouse, and supplier invoice. All right, so both of those things would be a pretty good proof that the accounts payable actually exists. I could also do a subsequent cash payment test, matching cash payments in 4 to 6 week period after end of financial year to accounts payable ledger. All right, now let's do valuation and allocation. Do this in a different color. When conducting subsequent cash payment test, match amount from bank statement to accounts payable ledger record. Let me see if I can come up with another one. Vouch accounts payable ledger for supplier to supplier invoice and evidence of goods received by warehouse. All right, and so see, you notice here that there's some overlap between my different procedures of the sorts of documents that I'm collecting. So I might be able to sort of collect a whole lot of documents and do some of these tests at the same time. All right, completeness. Now, completeness, let's do this in a different color. When conducting subsequent cash payment test, look for cash outflow that does not match to any existing accounts payable or other loans liabilities. I'll fix the color on this in a second, hang on. All right, and then our last one is rights and obligations. So let's go back, let's do this one in purple. Okay, so how am I going to prove that I have an obligation? For accounts payable, vouch to proof of goods received by client. All right, because we really don't owe the money until the goods are actually received. And there could be a bit of a cut-off issue, right? As soon as you order something, your system might automatically create the accounts payable. That's going to mean that you need to focus on those transactions around the end of the financial year. So, using a company that we know and some ideas about accounts payable, I've managed to generate multiple procedures, and you'll notice that the subsequent cash payment test comes up in a few of them so that we can have some efficiency. Right? I could probably do 2 or 3 assertions within the one particular test, but I've just made these up on the spot. All right, so I haven't, got a predetermined list. you can hear me thinking out loud on the video as I'm going forward. Any questions? Cool. So this is our last week of doing design work. We'll move on to some different topics next week. But remember, after this week, there's only 3 weeks to go, only 2 new lectures of work before we get to the final exam. Final exam information will probably come out in week 12. Thank you very much, everybody, and have a good evening.